starting with the market and just to see, so we try to just think about markets, and there can be various phases of market. One will be a boom, then there will be a bubble, then burst. From burst, it will be a good time to invest. So markets also has its own cycle. So boom, burst, and a good time to invest or good time to get out. So where we are today, and clearly when we, and I'll show you some of the data points, clearly we are not in a phase which is the best time to start investing, because we are somewhere in that bubble, not bubble zone, but in a boom zone. And this boom zone or a period is somewhere a period where it is one notch below the bubble. So if you have a very sharp return in the near term, if the market goes up sharply within a short period of time from here, then it will become a bubble. But if the markets doesn't go through that, and if there is a long slow returns from here, then this boom phase will turn into a good phase for investing for a long period. So to give you some example, to early 2000 or 2007, 2008 was the kind of the crash period for the markets. And from 2008 till 2013 there was hardly any return, so there was zero return in the market. In fact, that was in 2013 or a 12 or a 13 was a very good period to actually start investing into the market, because the subsequent phase was a very good phase. So economic cycles goes up and down, and then the markets also keeps becoming volatile around those economic cycles. So today we think that we are in a boom phase. Whether we'll enter into a bubble zone or whether we'll see a time correction, we really don't know. But why we think about we are in a boom phase? Some of the similar, so like the biggest reason is the valuations. And if you put valuations, you have to see it from two lenses. One is valuation on an absolute basis of Indian market, and one valuation of Indian market versus the global market. And if you see India's valuation compared to a global market movement, so India's valuation, of course, since India is a growing economy and a faster growing economy in the world, your share in the world market cap will keep increasing. There is no doubt about it. And that we completely acknowledge. But the problem here is, if you see in this chart, the pace of this growth is far higher than the economic growth that we are seeing vis-a-vis the world growth. So this speed of increase is just too high. And that is where it suggests that somewhere we have run already high. Now if you look at P and price to book valuations, P valuations are somewhere closer to the peak. But in 2018 to 20 period, the earnings or the company's earnings were in a down cycle, because there was NBFC crisis, so the whole banking industry was in a down cycle. So that's why to some extent the P was higher, because the earnings were not that high. But this time we are at the peak earnings and peak multiple. And this is easily getting reflected in the price to book, which is at around 3.9 times price to book, which is an all-time high that we have seen for a long period of time. So all these things suggest that we are in a boom phase of market. Now what happens in a boom phase? Does it always mean that we will have a correction, or does it mean that things going forward also can be good from an investment perspective? So for that, let's look at the economic cycle or the corporate ROEs. See, the economic cycle is in a good shape. Our current account deficit is broadly under control. And then the whole demographic dividend of labor, which will be coming into India's next 10 years, those pillars of growth are in place. Now on current account deficit, the government's focus of manufacturing in India for the whole consumption is a very good step, because it helps to avoid a lot of imports, and if you are able to control your imports, you have capital available for growth itself within the country. So it's a simple, if you understand your household, the more you spend, the more capital goes out of your pocket, and then you have lesser money left for your investments, and those investments actually help you grow your wealth. Similar way, for a country, your current account deficit is your money flowing out of your country. The more it flows out, the lesser you have to deploy within your country for growth. So the more, so that's why the whole, all these policies which stops imports and promotes more manufacturing of goods and service both, it just need not be only goods, even services. So the more it is done here, it is better, it gives you capital for growth. So those economic variables are in good shape, barring the only thing that we have to worry from a global perspective is that whether the crude price goes up significantly or not, and whether the whole import of power equipments like batteries and all these things for EVs, whether they come and affect us. So those are the two risks, but apart from that you don't have to worry much. So economic cycle is good. Now coming to, so if economic cycle is good, then your corporate ROEs also will be in a good shape. Given we are in a democratic country, capital being scarce, all businesses will deploy their capital on an aggregate basis in a sensible way. There will be some sectors which will go through down cycle, some sectors will go through up cycle, that is fine. But businesses will deploy capital in a normal way. So what happens, your ROE of the businesses will be a continuous steady line, it doesn't get affected. So your book value of all the companies will keep compounding at a steady ROE rate. Now markets behavior are always in and around, so market behaviors are sometimes ahead of those ROE accretion, sometimes lower than those. So because of that, volatility in the market comes. So today in the boom phase, what has happened, we have slightly gone ahead of those ROE accretions. So our valuations are already factoring in 2-3 years of those compounding of ROEs, which will compounding of book value which was going to happen. It's already factored in today, and that's why this 3.9 number is a slightly higher number. So either the market can go through some time corrections or some price correction, and the third option is that earnings actually comes much higher. Those earnings coming much higher are generally very rare when you are already in a good economic cycle. Only when you are in a bad economic cycle like 2012-13, where our economy was already suppressed, then it could have a capability to come back, or to 2020 also, when the economy got suppressed because of COVID, but then the later 2 years we had a very sharp jump in the ROEs. So those can happen only during that time, otherwise those are difficult. So expecting a big sharp earnings growth on a sustainable basis from here is difficult. So there can be, so now what it essentially means from a market and what should be the recommendation of funds. So from that perspective, and this is one simple chart that we put it in our fact sheet, and if you are reading our fact sheet, then every month we update this chart and put it. This is a simple, what we do is all the previous charts that I showed, based on that we try to culminate the market overall, and then our recommendations where we are. So when you are in a deep green zone or a green zone, that is a good time to invest in equities. When you are in a yellow zone, you are a neutral, and when you get into orange and a red, that is a time you move out of equity into other asset classes. And to give you some examples, in the past, in 2020, it showed a time where you have to be massively investing into equity, and this was published in our fact sheet then also, that one has to be investing into equity then. 2012-13 also it gave a very good signal, somewhere in 15-16 also it gave a good signal, and in 17, if I recall, 17 it gave a signal that you have to move away of market before the 18 to 20 phase where it did not deliver your return. So today where we are getting closer to this orange zone. So that is why we think that markets do not have too much steam to deliver you above average returns. Along with that, when you look at flows, so this is the small cap flows, all time high flows, and generally flows are like this. Whenever any category of asset class has given you good returns, flows will flock to that. And if you remember it, 2004 to I think maybe 5 to 2012 was a very good time for real estate, and a lot of money was flowing into real estate. And I remember it right, that in 2013 when we launched our close-ended fund of ours, we went and told people that equities is a good time to invest. People said no, real estate is a far better asset class, why should we invest in equities? And today look at the same thing, the behavior has changed. Small cap has done very well in the last 1 year, and now look at the kind of flows that we are seeing in the small cap. So in 2020 when the flow in the small cap category was far lower, when the valuations were lower, but in 22 and 23 when the small cap started rallying, the flow started increasing. So that's the behavior of market. Frankly, that's the behavior of investors. People want to chase any momentum, but money is not made by chasing the momentum. Money is made by staying away from the momentum. So what we recommend basically hybrid funds at this point of time, because in the next 1 to 3 years somewhere there will be a volatility in the markets. Yes, in the near term things looks very good. So like your investors will tell you, see, this is a stable government, we are getting a government with a very vast majority of votes, so they can really take tough decisions which can be meaningfully better from a medium to long term growth. All these narrative is correct. I do not disagree with those narratives, but the only problem with those narratives is that those narratives are getting priced into the stocks and the company's earnings today, whereas those things will take actually 4, 5 or maybe a decade to play out. So some of the structural reforms like GST and all actually brought first a disruption to businesses and their profits in the near term. So now if we have a land reform or a labor reform or any other reform, will it be first disruptive or will it be first adding to the profitability? That's the big question to ask, and frankly we do not know what is coming. And that is where, when there is an uncertainty, but market will not think that way. Sometimes market is more driven by emotions, and those emotions today suggest that everybody will feel more optimistic about it. And when you feel optimistic about it, you will try to price the stocks faster and faster. You want to chase the stock and you want to buy the stock today. So those things will lead to maybe short-term positive returns, and then maybe for 2 years no returns or some correction. I do not know, but that is what can happen very well in the market first. If you want to build yourself as a good advisor over a long period of time, what we have seen is that you have to give the toughest advice. You have to bite the bullet today. He may not like you in the near term, but he will remember your good advice over the long run, and then once he faces a trouble somewhere, he will remember that your advice was the best, and he will come back to you and he will stay with you for longer. So hybrid funds are better suited. Somebody who's coming in the equity for the first time, a low equity product like equity saving, and let's say if those individuals are people like in their 50s and all, giving them a low equity product is a better one. So either asset allocator fund or a BAF or a equity saving funds does make sense for those kind of investors. People who are more younger and coming into the markets, somebody's let's say in their 30s or 30s to 40s or 50s or up to 50, those people can be given products like multi-asset product or a equity and debt fund, where the equity proportion is higher, but at the same time there is a debt proportion, so the volatility in these products could be relatively slightly lesser than the pure equity product. So that's our recommendation. Now coming to the second part of the discussion, which is talking about more about the funds and how we have done in the past. So just to show you, so this is 2015-16 when the markets were low, our equity level. So the blue line is the equity level, the red line is the Nifty or Sensex level, sorry. So this is how the Sensex level has moved from 2015 till 24. But our equity level, so this is on the right hand side, so our equity level in 16 was around 80%, and all of you know that in 17 there was a huge rally in the markets. So slowly from 17, in the whole of 17 our equity levels came down, and end of 2018, that is when after that the tax was long-term capital gain tax was introduced and markets corrected. That time we had already touched around somewhere between 65 to 70% of our equity. So we had brought down our equity level systematically over the last 1 year when the markets went up. Similarly in 2020 when the markets corrected, we again touched a high equity level of 80%. So from 18 to 20, slowly and steadily we increased our equity levels, and then again recently we have started to trim down our equity, and if the market keeps going up, valuations keep getting stretched, we will keep reducing our equity level. That's a systematic approach that we have. The second area where we do look at creating alpha is changing your allocation between large cap, mid cap and small cap. So what we do here is when in the same, I have not put up a chart here, but in the same time frame in 2016-17 our allocation towards mid and small cap was very high. From that level we came down over the next 1 year when the small caps delivered higher returns. We reduced our mid and small cap to virtually a very low number. And then from 2018 to 20, when the mid and small caps were not doing well, we slowly and steadily kept on increasing our mid and small cap, and we again touched a good decently high number. And then in 2021 we again came down on our equity on our mid and small cap levels. So again that counter cyclical approach helps you to buy them when they are cheap, sell them when they become expensive, and when you have made your alpha, you protect your alpha. The third and the largest part of alpha creation is through stock selection process. And in that stock selection process, the three approach that we have, one is counter cyclical approach. Counter cyclical approach in a simple way is you try to identify businesses which are going through down cycle, and at the same time these businesses are trading at a cheaper valuations. So all these 4-5 sectors were going through a down cycle. Each of them had a different reason of their down cycle. Some had a global reason, some had a domestic reason. Now when these sectors were going through down cycle and their valuations were cheap, we had created a very high weightage in our fund in these stocks. And then over the last 4 years, you have seen some of these sectors have delivered you very high returns, and all of these sectors have different cycle. Like metals have a very short cycle, 2-3 years cycles. Autos and hotels have a medium term cycles, which is like 5, 7, 8 years. Power kind of a sector has a very long gestation cycle of 15-20 years. So all of them have a different cycle. Metals being a shorter in nature, they came out of their cycles faster. Those stocks delivered returns very quickly between 2018 to 20, from 20 to 22, and we reduced our allocations from there. So our counter cyclical approach is you buy sectors in down cycle, you sell sectors which are at the top of the cycle, and you don't know when the cycles will peak out and all, but you sell when they are already in their top of the cycles, valuations are already normalized. Then you do not take a very skewed bets, you reduce your weightage allocation to the sector. Apart from that, the same mid cap small cap allocation change also generates alpha, and the stock selection process is also broadly to a large extent similar process, counter cyclical, contrarian, value style of investing. So that's the multi-asset fund. Why this fund and what kind of? So it is again suitable to the similar nature of investor who wants to come into equity and debt, somebody in their 30s to little lesser than 50s, people who wants to put lump sum or SIP, both are, it is suitable. But at the same time, the investors also who wants to put money for themselves into gold. So again, instead of you buying and selling gold, there are a lot of transaction cost, there is a lot of taxation involved. Here the same small proportion of gold buying and selling keeps happening. If you see in this chart, these are annual returns of equity markets, bond markets and gold returns. And if you see, the green is the one where between the three which has done relatively well. There are times when equity markets does well, and if you see, there are times when equity markets or bond markets don't do well, but then there are gold or the other commodities also which do well. So it is somewhere a counterbalance to each other. So it actually increases a good investor experience. So in certain area, your gold part of the portfolio will help you deliver slightly better return. In certain part of the year, some of the years your equity will deliver, some of the years your bonds will deliver. So it's a good balanced approach of investing, especially in a market which is already quite expensive. This balanced approach of investing really makes sense for an investor. This is how the cycles of economy or the businesses work. So there are times when there is a growth, after growth comes the slump and recession, and then recovery and again the growth and all. So this is how economies keep working. Now the time frame for every economy will be very different. Some economies will have a very shorter time frame between 5 to 10 years, some might take maybe 15-20 years. So depending on where you are in terms of your demographic growth and all, you decide. And what happens in a business cycle generally, in a up cycle, when the cycle is good, consumers and businesses feel confident, factories run at a very high capacity utilization, then you have companies announcing capex or expansion plans, then employees gets good bonuses and they get a good job offers from the others, so they also feel good, so they spend more. So it's a continuous self fulfilling cycle, but then there are some macroeconomic variables which changes and which affects it. Like I told you, current account deficit is one of such big variable which can come and change suddenly the mood of the whole economy. So today, where are we in the cycle? Like we discussed, global macro is very much stable. Indian macro is into a good shape. So Indian economic cycle is actually in a good shape, even better than the global economic cycle. And is there any factor which suggests us that things will change? Right now, nothing. So now based on that, our top-down style of investing suggests that you have to be very much pro domestic cyclical stocks.